I'm always trying to make the best returns on investment, and of course, otherwise, why would we trade options or why would we do anything related to the stock market in the first place? And in this video, I wanted to show you how if you focus on some stocks that have certain characteristics, and I'll talk more about it, how you can make so much better returns than normal stocks. So let's jump right into it so you can see what I mean. Right now, I'm looking at the stock Twitter. So obviously, Twitter has been a lot in the news since Elon Musk has said that he was going to acquire Twitter. And since then, I mean, it's been quite a crazy ride for Twitter. We can see that when the news came out, the stock went from $39 per share to around like $47 per share. Now it came down to $40 per share. But what's most interesting about Twitter is that as there has been a lot of news around the stock that Elon was going to acquire it, the implied volatility rised. So if you don't know what the implied volatility, and I'll call it IV for the sake of this video, the implied volatility is the movement that we expect from the stock. So let's imagine that you have, for example, a chart where you have a y-axis and an x-axis. The implied volatility, you're going to see it move like this. And what it means is that the higher the implied volatility, the more we expect the stock moving. And when we expect more of a stock, when we expect a bigger move, what happens is that the option prices are going to follow the same trend. So if this chart is about the IV and we make another one that is about the option prices, you're going to see that it's very similar to the IV, meaning that as the IV increases, the option prices are also getting more expensive, and vice versa. If the IV decreases, then the option prices decrease too. They get cheaper. And that's where this relationship between the IV and option prices can get really interesting, because when we have, for example, a stock like Twitter that goes under the news like crazy, you know, all the media are talking about this stock because Elon Musk is trying to acquire it, then what happens to it? But what's really interesting when a stock goes in the news like this is that as the implied volatility is increasing, we're going to see the option prices getting way more expensive. And if you like to sell options, that's where it gets interesting. So we are in the option chain. So let's pretend that we want to sell an option on Twitter so you can see what I mean. Let's say that we go in the July 15 expiration, and you know, I'm not going to go in too many details about why I choose that expiration. I just want to show what it's like to sell an option on a stock with a high IV. Let's say that we decide to sell, for example, the 35 puts. You can see that there's a -1 already, as you can see here. And the reason is that I've already sold a put at the 35 strike on Twitter. That's why you can see there is already an order here. But what's really interesting is that if I was willing to sell a put on Twitter at the 35 strike again, you can see that I would collect a credit of $1.61, meaning a max profit of $161. As one option controls 100 shares, when you sell one option and let's say you collect $1.61 of credit, you multiply that number by 100 to actually know how much the premium represents in total. So that's why $1.61 times 100 equals $161. So far, you'd be like, okay, that's cool. So if you sell a put on Twitter, then you're going to make $161. Is that impressive? Well, that's quite interesting for several reasons. The first reason why it's actually very interesting is that if you look at the buying power effect, which is of $365 of debit, what that represents is that if you're willing to sell a put on Twitter at the 35 strike, collecting $161 of premium, you will need to put on the table $365 as a buying power requirement. So that's how it works when you sell options. If you would like to sell an option, you're going to have to give a certain part of your buying power. That is the buying power required. You're going to have to put that money to lock that money, and that's how you're going to be able to sell an option. And after that, that buying power required will fluctuate. Either it will become a bit more because the trade goes against you, or a bit less, but that's how it works when you sell options. It works with a margin. And typically when you sell an option, the credit that you receive, meaning that those $161, let's say that compared to the buying power that you require, if you manage to, let's say, receive a 15% credit to buying power ratio, meaning that let's say that you're going to make $15 for every $100 worth of buying power required, that's actually a pretty good deal. Meaning that if you collect $161 and you only need to put $365 on the table to open that trade, you're making a 44% return as a credit to buying power ratio, which is, I mean, that's enormous. You rarely see such a high, credit to buying power ratio, because usually you're going to be more around like the 10%, 15% as I said. If you get 20, then that's really good. So imagine 44%. I mean, that's really an incredible return, which makes it an extremely compelling case in a way that when you look at Twitter, which is a $40 stock, it's around like $40 right now, and you're going to make $161 per put that you're selling at the 35 strike, and you only need to put $365 on the table, it makes it extremely compelling to sell options on Twitter. And the reason why there is so much money right now in the Twitter options is that because there's a lot of implied volatility, because of all the hype that exists right now around Twitter, because Elon Musk tries to acquire Twitter, that creates a lot of implied volatility. And as I said before, the higher the implied volatility, the more expensive the option, and vice versa. So that's why you're going to have like such expensive options for Twitter right now. And if you try to compare it to other $40 stocks, you'll see that you usually don't get as much credit, or if you get as much credit, you will need to put a lot more on the table as a buying power required, which will decrease that credit to buying power ratio that I was talking about before, where it's like 44% on Twitter. You'll probably make around like 15%. For example, if you look at the stock FITB and let's say that you try to sell an option that is around the same level as we were looking at for the Twitter option, and the stock is around $39, so that's quite similar. But to show you the difference that the implied volatility does on the options, if I try to sell this option, I'm basically going to collect 75 cents of credit, as you can see, and which means a max profit of $75, but the buying power required for that trade is of $478, which is approximately a credit to buying power ratio of 15%, which has nothing to do with the 44% credit to buying power ratio that we had on Twitter. So what should you do? Should you, sell a ton of options on Twitter? Well, personally, I can't tell you exactly what you need to do. You need to figure out for yourself if that's a trade that you're willing to place. Do you want to have the risk of, for example, selling an option on Twitter? That's up to you to decide. But to show you what I did, so, I can be transparent and show the different trades that I take, I sold what we call a short strangle on Twitter. So you can see that there is like this -1 on the put at the 35 put. It means that I was selling a put at the 35 strike. And you see that also have this -1 for this 47 call, meaning that I also sold a call on Twitter. So I sold a put and a call at the same time. And what it does in terms of profit graph, if we look at my profit graph at expiration, you will see that this basically looks like this. So that's the strategy that we call a short strangle. It means that by selling a short strangle, we're betting that the stock is staying within a range. And for example, here I've sold the 35 put and the 47 call. So I'm essentially betting that the stock is staying within this range. And that's really interesting because I've collected so much credit selling those options, selling this put and this call, that I thought that it was worth it at least trying out that trade, because we're making so much money when selling those options. It would be a shame, not taking that opportunity. That's my way of seeing it. I'm curious to know what type of trades do you take? Would you like to take this type of trade, for example, or do you think maybe I'm crazy for taking that much risk? Let me know what you think in the comment section. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.